Hello everyone, welcome back to Accounting with Oscar. In this video, we're going to continue on our 2025 February-March Accounting Paper 1 discussion, particularly for the second half of the paper, questions 18 to 35. So in case you missed the first part of the video, you can look for it somewhere here, somewhere up, somewhere down. Okay, probably it's somewhere, okay? Or you can just click into my channel and look for the video, right? So before we start, make sure to like, share, and subscribe. Leave a comment down below for, more types of contents you want to see. I'll try to make it happen, right? I don't promise everything because I do have other jobs on the side, right? I'm actually working a few jobs. I am an accountant. I run an accounting firm. I lecture accounting in college, right? I lecture ACCA. I teach IGCSE accounting. I'm even teaching this UEC accounting as well, right? And I'm also handling some engineering business and an IT business on the side. So yeah, hands are pretty full. But whatever I can do, I'll try to make it happen. So let's look at question 18. A carpenter uses the revaluation method of depreciation for the hand tools used in the business. All hand tools in use at the end of the financial year, including those bought during the year, are revalued. So new hand tools were purchased during the year, but no hand tools were disposed of. Disposed of. Shouldn't it have two F's? I don't know. Dispose of. Disposed of. I'm sorry. Okay, now which value of hand tools shows the calculation of depreciation for the year? So this is something, it's a road less traveled by. I don't see many revaluation method questions being asked in the previous few sessions, so this is something new. So how do you calculate depreciation using the revaluation method? So I will take the value at the start of the year. Okay, we need to add in the value of the new tools purchased. Yeah, so we don't deduct. We're not gonna less the cost of new tools purchased. That's not the right way to do it. Less the value at the start of the year. Well, this will be true if there was no purchase, but in this case you're just ignoring all the new purchases. That's wrong. Okay, start of the year plus the value at the end of the year. Why are you adding the value at the end of the year? Doesn't make sense. So value at the start of the year plus the new tools purchase less the value at the end of the year. Okay, that makes much more sense, right? So D is the correct answer. Question 19. At the end of year 1, a trader created a provision for doubtful debts of 5% on the trade receivables. At the end of year 2, she decided to increase the provision to 6%. So what was the amount for provision for doubtful debts that should be included in the income statement, right? So you have to be careful here. They are asking for the transfer to the income statement. So how much was the increase or how much was the reduction if you're talking about the income statement? But if they're asking for the statement of financial position, then it is the provision at the end of year 2, right? So let's try to calculate 5% and 6%. 10% would be 480, so 5% is 240. 6% of 75, that's, let the brain work, 450, okay? So 240 and 450. Now, All in all, I can say that the provision has increased by a total of 210, right? 450 minus 240, $210. So an increase in provision, what does that signify? It signifies that there's an increase in the risk of bad debts, which is not a good thing. So it will become an expense to the business. Hence, we are going to debit 210. So to represent an expense, right? Represent an increase in the risk of bad debts. But if, okay, I'm just saying if the question is asking what is the amount of provision to be included in the statement of financial position, then your answer would be 450, and that will be on the credit side because it's a reduction to asset. Right, but if only they asked on the financial position, if it's the income statement, then you have to reflect the increase or decrease in provision. Right, let's bring you to question 20. The end of year inventories held by a sports shop are shown in the table. You have cost and you have net realizable value. Which inventory value is shown in the statement of financial position? Alright, so accounting rules. How do you reflect the value of inventory? So inventory is always valued at the lower of cost versus net realizable value. The lower of cost versus net realizable value. So this is in accordance with the principle of prudence, where you try not to overstate your assets. So the lower of, right? Football kits, we're gonna go with 230. Tracksuits, 210. Football boots, 160. Easy peasy. So 230, 210, 440, 160 would be $600. Okay, so that is the principle. The lower of cost versus net realizable value. Question 21. What is a disadvantage of running a business as a sole trader? So very nice of them to bold it for you. The owner does not have to pay interest on drawings. So you don't need to pay interest on drawings. Is it a bad thing? No, it's actually a good thing. It's an advantage over a partnership. The owner is entitled to all the profits made by the business. Is that a bad thing? Well, it is if you hate money. But yeah, it is an advantage, not a disadvantage. The owner must share the decision making and profits. It is a disadvantage, but it's not related to a sole trader. It's related to a marriage, right? A partnership. You gotta share everything, share half of your stuff with your wife. Yeah, that's a partnership. Be careful who you get married to. Okay, now the owner's personal possessions are at risk if the business should fail. This is correct. That's the disadvantage. So for a sole trader and a partnership, there's no separate legal entity. So you are the business is you. If you screw up the business, what happens is the people, right, your suppliers, your bankers, they can come, they can take your house, sell your house, take your car, sell your car, take your wife, sell your wife, take your kids and sell your kids. We don't condemn human trafficking, but you get what I mean, okay? So they can take whatever personal assets you have, sell it off, get the money back, and, say bye-bye. Question 22. What is shown in the capital and liability section of a statement of financial position? Again, this is a new type of question they're asking. We've not seen anything like this in the past couple of years. So they're asking you, what does capital and liability section reflect in the statement of financial position? So as you know, the statement of financial position is based on the accounting equation. So total assets will equal to total capital plus liabilities. Now, this capital and liabilities here, they are actually known as the financing part of the business. So you have your assets, right? You have a property. How do you get this property? So part of it might come from your savings, part of it might come from a loan. So C&L is actually the financing part. How resources are being used? No, not a good answer. This would probably be the income statement. The working capital is only short term, right? Current asset minus current liabilities. So that's not correct. Total amount owed by the business and owed to the business. This will be more of assets and liabilities, so that's not correct. So where the resources of the business have come from? Where does your financing come from, right? Where the money comes from. So capital and liability. That is the correct answer. 23. Anne and Ben are in partnership, sharing profit and losses equally. They provided the following information for the year ended 30th April. So your profit for the year was 20,000, interest on capital was paid, and drawings were made. So what was Ben's share of the residual profit? Careful with the wordings. Sometimes they would ask you for total profit. If they do ask you for total profit, then you have to include in the interest on capital. But if they only ask for residual profit, then our lives are a lot easier. Now, interest on capital, this is paid by the partnership to the partners. So this will reduce residual profit. Drawings have no effect, so we're gonna ignore them straight away. 20 minus 9, that's 11,000. So sharing equally, right? 50-50, that's 5,500. That is Ben's share of the residual profit. That's it, 5,005. So if they do ask you for total profit, then you gotta take 5,005, add in the interest on capital that he received. So that would be 9,005. Well, anyhow, you're lucky they didn't put it in as an option. I mean, I would, just to see the world end. I'm sure a lot of people would select that. Okay, but yeah, examiners are nice. They're not as cruel as you think they are. I'm not an examiner. Well, I may not be. You never know. Okay. Question 24. Frankie is a partner. He has both a capital and a current account. Which statement is correct? A. Any loans he makes to the partnership are added to his capital account balance. Capital account. This records what? It records the long-term investment of the partner. Well, bear in mind, it's an investment, it's not a loan. If he makes a loan, we will open a separate loan account. It's not an investment, we have to pay him back. B, he can have a debit balance on his current account. That is correct, but not his capital account. That is also correct because you can't have a negative investment. So I opt for B as my answer. But I'm going to go through options C and D for you as well. Interest on drawings would increase a credit balance on his current account. So credit balance is where you record the share of profits, right? Interest on drawings is not a share of profit. This is actually a reduction to the current account. So it increases the debit balance, right? Interest on drawings is owed by the partner to the partnership. For D, the balance on his capital account falls when drawings exceed share of profit. Now, this is true for a current account, not a capital account. Capital account balance will only fall if there's a withdrawal of capital when the partner ceases to be a partner in the partnership. So basically when they retire, when the partner retires and you return his capital, that's where the capital account falls. Right. So let's bring you to the next question. What is included in the equity of a limited company? So equity, we have general reserves, we have ordinary share capital. Debentures are loan notes, right? They are loan notes, so they identify themselves as liabilities. Goodwill is goodwill, right? It's a value of your business. We can say it's a business valuation, right? To make it simple. So this would be an asset to the business. In fact, it's an intangible asset where you don't see the physical item, but it's there, right? So 2 and 4 would be your only answers. General reserve, ordinary share capital, right? I mean, there are others as well. You have your retained earnings, you have your preference share capital. Of course, preference shares, you gotta be careful. You have to look at whether they are redeemable or irredeemable. So if it's redeemable, if the company can buy back the shares, then it becomes a liability. But if it's irredeemable, it's permanent. So that will be capital. (26) What is shown in the receipts and payments account of a music club? Receipts and payments, money in, money out. A summary of all cash and bank transactions. Yes, so the receipts and payments account is like the cash book of a trading business. Depreciation of musical instruments. I'm sorry, this is non-cash. It doesn't appear in receipts and payments. Subscriptions received. Yes, but accrued? No, because accrued is still non-cash. They have not paid. The club's surplus or deficit. Now, you'll see this in the income and expenditure account, but not exactly receipts and payments, right? So A would be your best answer. (27) Medway Social Club runs a cafe for its members. For the year ended 31st December, sales were 15,000 and cost of sales was 12,000. The closing inventory of coffee had been included at a cost value of $1,000 but had deteriorated and was only worth 500. Right, so the quality has dropped. We have to adjust the value of closing inventory. Why? Because according to the principle of prudence, you need to value your assets, okay, in this case inventory, at the lower of cost versus net realizable value. So we can't use the original 1,000, you have to apply the $500 because your inventory has deteriorated. So in the cost of sales, I need to minus 500. Okay, we have to minus 500. Is it true? Caught you there, right? You don't minus 500, you add 500 to the cost. You see, this is the cost of sales. So it's actually opening inventory plus purchase minus closing. What you're doing now is you are reducing the value of closing inventory. So when you reduce the value of closing inventory, you're technically increasing the cost of sales. So we increase the cost of sales to 12,005. So 15,000 minus 12,005, that's where you get a profit on the cafe of 2,500. So you have to be careful to some of the adjustments that you make. Now moving towards question 28. Which statement about work in progress is correct? So going back to manufacturing accounts, it consists of completed. Is it? No. So it's only partially completed, right? Completed goods are never recognized as WIP. Adjusted when calculating prime costs? No. Right? Prime cost is the sum of all your direct costs. So direct materials, direct labor, direct expenses such as royalties, but not WIP. It is included as inventory in the statement of financial position. Yes, this is correct. So it's reflected as a current asset. But we're going to check option D just in case. It is included in the manufacturing account. Yes, we are going to adjust. Well, do you? Yeah, I mean we do, right? We do add in opening the bill IP less closing the bill IP. Well, what happens? You add opening the bill IP, right? Add opening work in progress less closing work in progress to find your production costs. So is it really included in the manufacturing account? Well, you're not. You're taking it out, right? Less closing the bill IP. So that's wrong. Income statement, do we? Do we bring it to the income statement? Well, we bring production costs, right? And you bring opening and closing inventory of raw material. But we don't really touch much on the WIP there. So yeah, safe to say C is the correct answer. (29) A manufacturer calculated the cost of production for the year at 57,000. It was found that lighting and heating of 2,000 had been omitted from the financial statements. 75% of lighting and heating is allocated to the factory, 25% allocated to offices. Now, what is the correct cost of production? So cost of production, you have to take in your prime cost, adjust for factory overheads, and adjust for work in progress. So 57,000, I need to adjust for the overheads. So 75% gone to the factory. That's what I'm taking in because that's production costs. Anything relating to the offices or relating to sales are basically non-production overheads. So we never include them in. So 75% is 1,005. So I'm gonna add 1,005 to the cost of production to arrive at 58,500. Simple as that. As easy as 1, 2, 3. Okay, I gotta stop. I can't let my age reveal itself. Yeah, era of Jackson 5. Okay. Now 30. Farad did not keep a full set of accounting records. He purchased goods on credit terms and all sales were made on cash basis. Farad compared his assets and liabilities at the start and at the end of his financial year. He recorded the following changes at the end of the financial year. So there's an increase in your non-current assets by 11,000, a decrease in inventory by 6,001, increase in payables by 3,000. The bank balance had changed from a debit balance of 4,002 to an overdraft of 7,001. What was the change in Farad's capital? Yes, something new here. We don't see this often as well. So change in capital, something to explore. Right, how do you calculate a change in capital? So this is where I'm going to use incomplete records, right? Apply incomplete records using the net asset approach. So increase in non-current assets, this is something good. It's going to be added. A decrease in inventory, reducing my asset. That's not good for capital, so that's going to reduce. Increase in payables, liabilities going up, not a good thing as well. That will reduce the capital, right? Because you got to use asset minus liability to calculate capital, right? So any increase in asset is good, right? But any reduction to asset or any increase in capital, that's a no-no. Right, so we worked that out. Now, time to do the bank balance. Initially was a debit of 4,002 turned into an overdraft of 7,001. Now, if you are gonna take 7,001 minus 4,002, you are very wrong, right? So you have to understand that from a debit balance to turn into an overdraft, we first need to reach the point of 0, right? So that's a reduction of 4,002 where the bank balance from positive turns to 0, and from 0 you move on to an overdraft of 7,001. So that's a further drop, right? A further drop in the bank balance of 7,001. So all in all, the bank balance actually reduced by 11,300. So 11,000 minus 6,001 minus 3,000, right? Minus 7,001. So do the math and you should get a decrease of $9,400. Now let's bring you to question 31. Business provided the following information. Revenue is 100,000, gross profit is 20. So what was the percentage markup? So a little bit of cost structure here. Now there are two types of cost structure. Markup is where we calculate our profit based on cost. And there's another one called margin. That's where you calculate the profit based on selling price. So if I'm talking about a markup here, I need cost data. Do I have any information on cost? Well, I can calculate, right? So revenue minus gross profit will give me a cost of 80,000. So markup would be 20 over 80. So multiplied by 100%, that will be 25% markup. Okay, that's if they ask you for a markup. If they ask for a margin, okay, just for fun, let's try to do this. If they ask you for margin, then you have to take the profit over selling price. So that will give you a 20% margin. Now, if you mess this up, you select A, congratulations, you got a wrong answer. Alright, so always be careful with margin and markup. Make sure you are able to differentiate between those two. They're like twins, you know, you just have to make sure you don't kiss the wrong sister. Okay, so 32. Why might a trader wish to increase his trade payables turnover days? Right? Why do you want to owe your suppliers for a bit longer? Why do you want to increase the payables days? To improve his total working capital. Working capital is current asset minus current liability, right? So when you actually increase the amount you owe your payables, that increases the current liability. So you're not really improving working capital, it's actually worsening. To keep funds available for other purposes. Yeah, so probably to use the money elsewhere, I would agree. Right, to receive more cash discounts. No, if you increase the payables period, you actually lose out on all your cash discounts. So 2 is the only correct answer. Right, let's go to 33. Uzoma provided the following information about the first year of trading. So sales 46, gross profit 21,850, advertising 2,007, other expenses 11,350. You end up with a clean profit of 7,008. So Uzoma wants to improve her profit in the future and is considering 4 options. Which option would provide the biggest increase in her profit for the year? Now, a lot of comments, a lot of people are saying that this question was tough because it was out of the ordinary, right? You don't see questions like this normally, you know, giving you the biggest increase in profit. So a lot of people actually found it tough, right? Difficult to answer. But I tell you, among the 35 questions here, this could be the easiest one to score. It could be, you know, one of the easiest ones. So to get the biggest increase, we're going to analyze options A to D, look at the effects on profit. So earning commission, which would increase the profit by the year, profit for the year by 20%. Let's think about that. So increase the profit for the year by 20%. 7,008 plus 20%. How much do you get? 9,360, right? So you just gotta add 20% to the profit for the year. Increasing advertising by 1,000, so minus 1,000 from your profit, which would increase the gross profit by 2,005. So add 2,005. I know it says gross profit, but it's still rolled down towards profit for the year. So 7,008 minus 1,000 at 2,005. You get $9,300. Okay, that's not a good option. A would be better for now, right? C, increasing the sales price, which would increase gross profit by 2,000. So 7,008 at 2,000, that's 9,008. Okay, so A and B are out. C looks pretty good, but let's look at D. Reducing expenses by 1,005, that will increase your profit and earning a commission of 1,000. Good. So we're going to increase by 2,005, which gives us the final answer of 10,300. So that's the one you want to pick. The rest are sus, okay? That's the final one you want to go towards. You know, it's like searching for a skull in a haunted house. Okay. Sorry, Oscars. Haven't had my morning coffee. Started recording at 6. And I slept at 2:30. Good. So that's about 3.5 hours of sleep. Probably, I don't know. I slept at 2:30. I woke up at 6. Yeah, probably so. Well, I want to get this done, you know, because I know your paper 1 is coming. So, well, if I did help you in some way or another, just leave a comment, give me a like. I'll be happy, right? Just subscribe, share this to your friends who need help. Okay, question 34. Sally's business has reached its overdraft limit of 1,005. Sally is considering the following actions: asking the bank to increase the overdraft limit to 2,000, borrowing 2,000 from a relative and paying the money back in 6 months, obtaining a loan of 2,000 from the bank, repayable in 2 years, paying 2,000 from Sally's personal bank account into the business bank account. Which actions will improve the working capital of the business? So you reach your overdraft and you gotta find ways to get money, right? So you want to improve the working capital. Working capital is in the short term, right? So you want to improve short-term financing. Asking the bank to increase the overdraft limit to 2,000. Now, this is gonna be a short-term solution, right? Will it improve working capital? Not really, because, well, CA minus CL, right? You're still gonna increase the liability, which is not good, right? You don't use short-term funding to fund short-term operations. No, it's not good, right? So this will increase your liability. Not a good way to increase working capital. Now, borrowing 2,000 from a relative, that could not be more wrong, okay? Never borrow money from a relative. So, payable in 6 months. Again, it's a short term, so not a good sign because current liability is going to go up. Now, borrowing a loan from the bank payable in 2 years. This is stretching on to a longer term. This is a smarter option, right? 2,000 from your personal bank account. So, introducing capital. Try not to affect the liabilities. Very good. So 3 and 4 would be the correct answer. Right, and it all comes down to this, the last question, question 35. When does a business recognize the income from the sale of goods on credit? Now, this question has come out before. Yeah, it came out a couple years back. A lot of people still get it wrong. So when do you really recognize a sale? Do you recognize a sale when the customer orders? Do you recognize a sale when the money is received? So the correct answer should be when the goods are delivered to the customer. That's where you can recognize a sale. So it's actually when you've done the transfer of ownership, right? So you send the goods to the customer, the ownership has transferred. That's when you can recognize a sale. Alright, so that's 35 questions covered for this 2025 February-March paper 1 accounting. So thank you all for staying here for possibly, I don't know, an hour and a half, 2 hours. I lost count, right? Haven't had my morning coffee. I've been awake since 6. Okay, so alright, thank you all for staying by. If there are any questions you have, you can leave a comment down below. If you want to share anything with me, yeah, leave a comment down below as well. If there's an answer you want me to check, leave a comment down below. Or if you just want to stay for a chat, leave a comment down below, right? I'll be more than happy to do so. I love interacting with y'all. I mean, it's good. Keep the comment section alive, right? Feel free to interact with one another. We're going back to the era of replying on blogs now. Well, not really a blog, but a YouTube video. You know, who knows, right? Might make a good pen pal here. So, yeah, thank you all for coming. Make sure to like, share, and subscribe, and I'll see you all for possibly the next video. Let's hope it won't be too long. Yeah, I gotta think of new content. So I'll see you all there, right?